All right, welcome back, everyone, to the Financial Summit YouTube stream. We don't often do guests, but we should bring them more often. And it was awesome that I got back in contact with the one and only Willy Woo. I haven't done any streams with him in probably 2 years now. Willy, welcome back. And you brought friends. Your new venture with the analysis company that you guys are going to tell us about. I will try to keep my intros as short as possible. I'm going to hand it off to Willy. How you been, man? How was life? How the travels? And what's been going on?
Hey, Tone. Yeah, it's been a long time. I think, it must have been almost 4 years since I was regularly on the show. Yeah, I mean, had a baby, doing a lot of new projects. Right now, I'm partnering with Swissblock here on the show. We can talk about that a bit later. I'm also running a series of funds. So we do a series of institutional grade trading funds, a fund of funds that allocate into trading within the ecosystem to give a yield on either your Bitcoins or your US dollars. One of them is with a Swiss private bank. And I'm actually in Zurich right now doing some bank meetings. So that's me. I've been in the space obviously for a while. 2013 was when I first entered being full-time analyzing the blockchain for Signal since 2016, so 9 years. Obviously did my newsletter back in the day of the last cycle. And I'll just pass this over to Yann, I think, because we can talk about what we're doing this cycle with market intelligence on Bitcoin.
That's good. Thanks a lot, Will. So I'm Yann, one of the co-founders of Swissblock. We are a proprietary fund that has been trading systematically in crypto for about 8 to 9 years now. And I'm also one of the co-founders of Glassnode. That's how Willy and I got into contact about probably 7 years ago at this point, right, Willy? It's been quite a ride as well. And we basically are now at a level where we've so much data information and gathered so much knowledge of what not to do in the space that we basically thought that it might be the right time to actually partner up and create the next level of research and delivery for making things very actionable, understanding crypto and Bitcoin specifically for what it is. And like Willy said, we're going to go a little bit deeper in a second to what it is that we actually do. I'll hand it over to Henrik.
Yeah, and I've been part of your journey also, Yann, you first for the last, let's say 2.5, 3 years now. And only recently met you, Willy, but interesting to have met you and to understand your perspectives on the world. My world is from the macroeconomic background. I have had my own channel, the Zeberg Report, at some point also, but now diving into macros and trying to make sense of that in relation to Bitcoin and in relation to crypto at Swissblock.
All right, thanks for all the intros, guys. I forgot to share my screen. Everyone's information is in the video description. Everyone's Twitter handles, the company website, and also they're going to tell us a little bit more about Bitcoin Vector specifically. And you guys have your own YouTube channel as well, the Swissblock, where you guys do post your analysis. I saw your last 2 shows. It's going to be good to discuss what's going on. I know I have questions. Our audience might have questions. And yeah, Willy, you were saying something, but also tell us a little bit about Bitcoin Vector.
Sure. Actually, I was going to jump into that. Is that where we're at? Also, wait. Before we start with this, Yann's been very humble. Swissblock. We're the guys behind Glassnode. They've been trading using on-chain data as part of the data set since 2015, 2016, I think. Now, a lot of the low-hanging fruit got spun off into Glassnode for the world to use. And they are one of the best trading firms within the ecosystem that nobody knows. And so in the last cycle, some of the very big, large global macro funds went to Swissblock to really understand in a deep dive what is Bitcoin. We don't mean is it digital gold. We actually mean how does it behave in the market, in the global macro market. What is its role? What does it do? How does it behave when we have different price pressures? And so that's what Swissblock is very, very good at doing. And as this cycle, when we see, obviously there's spot ETF come out, and Michael Saylor launching a whole wave of really copycat Bitcoin treasury companies. We can see the whole thing becoming institutional. It's becoming a sovereign asset. And we think that, the traditional finance will come in here and represent Bitcoin. The Bloombergs, the Morningstars of this world. And so what we were thinking with this is, look, we've had 10 years of experience from a data perspective. And, our models are getting quite good. Like the models I have is another 5 years on from my last publication. And so we feel like we can represent the space within our own ecosystem from the Bitcoin ethos. And so that's what we signed up to do with the Bitcoin Vector. This one is really pitched for institutional entities. So if you're a professional trader, you're a family office, you're in the industry, you're a global macro hedge fund. That's the product, the core product that's being worked on, and we release that every week. The advanced version has live signals, so maybe I'll circle back to Yann to talk about that afterwards. But and hopefully we're going to do a retail version as well that will help hodlers stack sats at a better price point for retail.
Awesome. Thanks for the explanation, Willy. And real quick, guys, I always forget, most of you are watching on YouTube, but we are streaming live on Twitter as well. If anyone watching right now, if you can shoot over to Twitter, go to the Financial Summit and just hit the like button and retweet us on Twitter. And this way more people get to see the analysis streaming live directly to Twitter right now. Okay. And on that note, unless Yann or Henrik want to add anything else to the intros, we're going to jump right on with the analysis. We good? All right. Real quick, I want to take just 3 minutes. I just want to mention my views on the market real quick on this channel, because I haven't looked at the charts yet. It's still super early morning. And man, I really... this reversal that took place caught me a little bit by surprise how fastly we went up. I expected us to get rejected by the moving averages that were supposed to cross over, but on the geopolitical news, we reversed very, very quickly. And I think we are in a slight bullish posture, but we're not out of the woods yet. That's just my very, very brief analysis. Those of you that watch this channel every day know the details. And on that note, I'm going to cut my screen share. And who is going first with their screen share, guys?
It'll be Henrik. Because we usually do the big picture and then we zoom in. So we'll go with Henrik to take the global macro.
Right, but who's doing the screen share for that? Henrik is on a cell phone.
Yeah, I won't be able to do the screen sharing today, but maybe I can rephrase or try to draw up the picture of what I see. So I think that we're seeing right now in crypto and in Bitcoin is very much driven by the liquidity that's coming into any business cycle where we see where we're in the late phase, where we see central banks from around the world starting to think that maybe they have to stimulate, maybe they need to make sure that the economy doesn't fall into a recession. That's not so much the case for the Fed at this point, but it's absolutely the case for central banks around the world. And that's why we start to see the M2 moving up quite quick. And that has a huge impact on what's happening in the crypto world. I may have my doubt and fear on how long and how far this can take us, but I am very bullish from a macro perspective on what we see in Bitcoin at this point. I actually also think we saw a nice move up higher here with a reversal just some few days ago, but we had to see if we're gonna get into a summer doldrum here before we actually get the next strong move higher. But it needs to be seen. So, but for now, I think there's a strong support liquidity-wise in the economy for what we're seeing, and if I'm right that we're going to get a recession down the road, then we'll have to see what then happens to Bitcoin. But that's for another day, I think.
Okay. Yann or me? What do you think?
You know what? I actually have a question for Henrik real quick. I'm going to jump on my screen share since he is not able to do it. And there's a lot of background noise from someone. I'm not sure who it is. Okay. So in your video, Henrik, I believe this is one of your charts, correct? If you can see
Yeah,
my
that's my business cycle model. So thank you for
correct.
bringing that up. Yes.
Yeah. So I was hoping to talk to you about this, but you're not able to do screen share. So I'm doing screen share on this from your last video. Can you just describe what we see here, and I'll give it back to you.
Absolutely. So everybody talk, and macroeconomy is a top. I think maybe Yann, it's you that we can hear you when you're writing.
Oh yeah,
Yeah.
guys,
think,
can you guys mute the Willy and Yann? You guys mind muting? Or I can mute you guys.
So what we have when you are a macroeconomist and you talk about business cycle, there are many ways of defining that. This is my way of doing it, and what you see here are three indicators or indices that are indicating the leading, the coincident, and the lagging indicators. And what are those? Well, the top one is the one that tells us when where we are going. So the moment, and just to keep it short, we see that the red curve here, just don't think too much about the blue one, but the red one crosses over the horizontal curve. That is when the model tells us that now the leading indicators have been weakening so much that it's like the Titanic hitting the iceberg. There's no going back. So every time you have that crossover going back, as you can see here, back to the 70s, but actually even further back to the 50s, you will see that then it leads a crossover down on the coincident indicators, which is the employment, manufacturing levels, GDP growth, and so on. And you can see how a crossover on the leading then leads a crossover with the red and the horizontal on the coincident. And that is the moment when the economy is actually close to falling into a recession. And there you can see, if you go back to the last many recessions, the model actually predicted the recession start in November 2019, and the real recession started in February 2020. You can see then the previous one into the financial crisis we saw November 2007. The real recession set off in December 2007, and so on and so forth. So it's not, I mean, it has been pretty correct on the, or precise actually, even on the last few ones here. It wasn't so precise with the one in the 80s, but it still got every one of those. So this is very much unlike what you hear any other economist would say or any bank would say. They say you cannot predict recessions. Well, you got it right here. You can predict recessions. And what you have now is that the leading indicators are actually crossing over, and they did that in November 24, which means that in a normal setup, you'll have 2 to 4 quarters before we then see the rollover of the coincident. And that's very close. That would be then close to what would be the onset, as I see it, of a recession. So right now, we have seen all the leading indicators actually weakening a lot. And this will be the yield spread. We have seen the yield inversion. We're now starting to see those spike up. We see the housing sector is frozen solid in the US. So if you look at mortgage applications and all that, so that shows us that this is the big thing of the economy that is pulling the economy lower or down. And then it will slowly spill into the real economy. And that's what we're now going to be waiting for. We can start to see that happening in employment, and we start to see how the initial continuing claims actually are moving up now. That is a weakening sign of the economy, and I think you're going to see more of that. So I think this is telling us that a recession is coming. It's not right here. And I also, down beneath all of this, there's much more to this model than what just here. I don't want to talk about the laggings too much here, but if you go down beneath and test on, look at all the underlying indicators here in the indices here, you will actually see that there is a slowing of the economy, and it's just a matter of time, but before we then see that rollover. So we may talk about tariffs, we may talk about war in the Middle East and all that, but that's not really what drives the real economy. The real economy is driven by the consumer. The consumers, the 70% of the bottom, of the consumers are the ones that drives the market. Drives the economy, and the economy drives the market. So that's what you see here.
Okay, gotcha. And I see that it's great that you've listed what the leading indicators are, what the coincident indicators are, and what the lagging indicators are. But can you just be a little more clear what the red line is versus the blue line?
Yeah, I think it will come very technical here. So these are actually just averages that that moves up and down here, and that gives us a crossover. And what you'll see is that when you have the crossover between the red and the blue line, that's actually when the economy starts to become strong enough. So if you have the leading indicators go from the red, crossing upwards through the blue one, you will then see that you have an economy that is now strong enough. If you follow that and use that as a trading tool or trading background, you can actually see that it's been overperforming the market like 7 times. So, but that's for another day. So the model here is to predict when you have a weakening economy or you have a strengthening economy, and then there will be different ways of actually analyzing this with moving averages.
Okay, no, but no, my question was more: what is the red line and where's the blue line? Like, what's the difference between them? Are they different averages of the
They're
leading
different.
indicators?
They're different averages, but I want to keep some of the technical details
Right.
to myself here.
Okay, no, it's not technical. It's just a general thing. So is it
Yeah,
different, I guess, algorithms of utilizing the leading indicators? Is that a good way of phrasing it?
you can call it that. Yes, please. Yeah.
Okay. Okay. Perfect. All right. Anything else you want me to screen share before we hand off to Willy or Yann?
I think it's fine. So this is the background, and that's why I say we are late cycle. We are late. We are in a situation where we have seen the weakening in the leading indicators that is going to pull the coincident indicators down, as I see it, which means that we already now should start to see that weakening in the economy. This is for the US, by the way. In the Europe, in China, and elsewhere, this is much worse. And there you already have a crossover, but in some countries, of the coincident indicators. And this tells us that you'll have that the US is the last man standing. We're not there where we see the most liquidity coming in, but we see that elsewhere, and that is now finding its way into risk assets, which is normal. What we see into the final phase of a bull market and the business cycle.
Gotcha. And this is US only, or is this a little bit global?
This is US only.
US only. Okay, got it. All right. Very, very good. Yeah. So it looks like Trump never had a chance. We crossed the point of no return the month of his election.
No, he never had a chance. I think it's if you look at the size of the bubble in this market, I think it's going to be bad at some point. And whoever has won the presidency is going to inherit this, what I think could be a very big, bad crisis. But let's see about it. Let's see if the model is right.
All right, very cool. I'm going to come off screen share. Willy or Yann, which screen share am I turning on for you?
I think Willy, you go first macro, and then we'll go into the more details.
Yeah, because Yann does microstructure. Let's
Willy, you took your screen share off, so you got to bring that back up for me to share to the
okay, it was already on. Okay.
Yeah, it was on. I just got to toggle it in to the stream.
Okay. I think that's, here we go. Let's go.
There it is. And here we go.
Okay, so interesting to see S&P's ripping. I'll come back to that because we're going from outside in, so we want to go into the big zoom out, picture, which, let me just get this chart going a bit better, turn off all this background stuff. This is a risk signal, and what it's doing is it's measuring liquidity in Bitcoin, the buy-sided liquidity coming into Bitcoin. So we're measuring here the pretty much the capital flow coming into the network relative to the pricing structure to detect areas where there's strong liquidity, areas where it's weak, and you can see that that early in the cycle the risk drops very, very low, and late in the cycle the risk climbs. It's another way of saying that liquidity is starting to drop out of the market, and that usually means that the price becomes unstable, and then we're heading for a bear market until liquidity comes back. We saw it in this last cycle coming in here. It started dropping at the bottom of the bear. The risk started dropping, meaning liquidity came back in. And once again now, we're seeing this run up again. So that is a warning sign that we are late in the cycle, that the countdown timer for the market top is starting. And so, if we were to look at this here, that would have said, in the 2017 cycle, $2,500, yet it went to 20,000. So not saying, sell everything, it's the bear market now. It's just saying that the structure of the market is now getting less liquidity, more unstable. And so again, here, it was actually when we broke 20,000. And here, we have to, we know it's coming. It's very hard to time the top, so I'm not going to do that. But I'll take you through to another view of it. This is another view of the liquidity model, but clearer for the larger cycle, because you can see here the risk model is kind of, you can trade it and you can use it as a trading tool within sort of medium term, where the risk dropped down here, and actually it meant that liquidity was coming in on this upward swing. But here we go into the sort of the macro picture, and what we'll hear is we're measuring the liquidity in the market over the entire cycle, and you can see that we actually we peaked its liquidity in December 2024, and it's been running down since. And generally, or let's say historically, every bear market started when we crossed this dotted line. And even in the 2013 cycle, we had the double pump that crossed below. And again, at this top, it crossed below that dotted line. That's a 1.33 standard deviation. This is measuring liquidity and standard deviations from its norm. And so we actually have crossed that just a couple of weeks ago. And you'll notice that here, last cycle was very unique in that it crossed and it did collapse, right? And it started to collapse down into here, and it was going very bearish. People were very bearish. And then actually paper came into the system and pumped it up. And so the paper in the system kept peaking. And this is a new thing, because paper was only brought into the Bitcoin market at the tail end of 2017. This was the very first market cycle that we had the paper, the derivatives. And so it adds another sort of thing that we need to look for, that we're crossing in here. We're expecting a bear market coming, but we don't know how much paper's coming into the system, as in how much paper bets are buying in urgently. And so that takes us out to, where we're poised. We do think that we're going to break all-time highs before the top. We expect another, I expect another move upwards, but, we're running against the clock right now with the structure really starting to dry up. And so here we're going into a medium-term view. What you're seeing here is actually the capital coming into the network. You can actually see it here. There's 2 billion at this level. Up here, it's getting close on $3 billion per day coming into the network. So you'll hear, X 100 million came in last week on ETS, X billion came in with MicroStrategy per week. This is measuring all of it. And so some people get caught up with this idea of, wow, look at the billions coming in. And it's counterintuitive, because when there's a lot of billions, the inflow is really high, the chances of it dropping is more, right? Because the next day you're going to pump in even more capital, and price does not get moved by the absolute amount of capital coming into the network. It gets moved by the increase or decrease of that capital. So as you're only a few 100 million is coming in here, but you're increasing it, that's enough to lift price. And so I liken this to like a skydiver in a wind tunnel being blown upwards by the flow of capital, and it's finding a balance. And if you slow down the turbine of that wind tunnel, then there's less upward buy pressure and the price will come down. And so we're presently in this sort of semi-bearish phase, but it has stabilized. The last few days have seen an uptick with this price rise. In the yellow, what you're looking at here is a leading indicator on this capital. And so this is more the speculative guys. And so we did get that bottom right there, if I zoom in a bit more. And we've seen a lot of speculative capital come in just recently. And so that pretty much called the bottom. That ticked up. And right now what you're seeing is a lot of speculative buying. But actually, overall, the flows are very neutral. And what that means is it's still a very tactical environment. We're not fully in a fundamental like tailwinds with a lot of capital coming in to support a massive bull run. But if this continues to climb up, there's times where it sort of stabilizes here and then you get a really large run up in capital. That could still happen. We just need to be aware that there's a lot of profit in the books right now. I'll switch over to this view, the SOPA model, a good old-fashioned SOPA, which is really measuring the profits that's transacting between the new buyers and their old investors selling out. There's still a lot of profit in that activity, so they could actually dump and profit take to add more sell pressure. I'll turn that off and turn off the SOPA, and let's turn on, well, the purple here is the speculative oscillations. And so it's good that the amount of FOMO in perpetual swaps and futures is now tapering down, which is a pretty good setup for a run. And so that's good. That's healthy. It's not too much paper in the system. And so when this actually solidifies and we get the capital inflows, we'll be in a very good situation locally over the next month or two to run up. And also the yellow, which is the VWAP, is this is my indicator of how overheated it is. And it's cooled down and it's recovering. So the oscillators are saying that we can do a swing up. The only thing that's missing is actually this capital flow to really come up. And then we've got a lot of profit on the books that could potentially dump, but they won't if the price is running up. So that's the situation right now. I think we might go to this liquidation chart by CoinGlass, and it shows you the setup here. While we're in a relatively tactical environment where the flows are very neutral, it's easy to push the price around. Actually, that is the driving force of tactical trading between buyers and sellers, speculative paper traders. And so right now, look, there's a lot of liquidations to be had above 99, and so it's likely we will take out that cluster. There's a cluster here that we might take out here, but if we can get the price safely above 103, this should teleport up to 105. And zooming out, there's a lot of short liquidations that can take us nicely to, looks like 117 right now, to all new all-time highs if we can get past that resistance. And I believe to get past that, the most healthy setup is with the capital flows coming in. So that should paint the picture. I'll hand off to Yann to dive a little bit deeper into the microstructure and how we're placed with Bitcoin relative to the altcoin cycle.
Yeah.
All right. I just want to do a quick shout out. We have over 6,000 people watching us on Twitter, on X right now. I still say Twitter. And Yann, I'm gonna flip over to your screen, and everyone other than Yann, please maybe mute unless we got some kind of a sound coming from the back. Maybe I could specifically mute people. We got some background noise here, but wait, I'm on my screen share, not your screen share.
It might be I have a ventilator. I'm in Italy. It's pretty warm here. So
okay, yeah, it's definitely better now. That was definitely you, Yann. Okay, so here we go. You are on screen share, and
Sounds good.
go ahead and go for it. I'm gonna drop the cameras to make the screen big, and here we go.
So before we go into the microstructure, I wanted to touch upon something that Willy was mentioning before, which is really liquidity. And to maybe take a step back, the way that we look at Bitcoin, the way that we always have looked at Bitcoin is basically from a complex system perspective, and understanding that at the end it's a dynamic between number of market participants and how often they share resources between each other. This resource in this case here is the underlying asset, which is Bitcoin. And what that basically tells you is that at the end of the day, over the years with all of our research, is that Bitcoin is a super sensitive asset to liquidity expectations. So we call it the canary in the coal mine for liquidity, because it tells you exactly what is likely to happen in the future as basically liquidity due to devaluation of currencies or due to shifts in how people trade risk on, risk off in different asset classes on a macro level, how that basically creates a repricing of the system. So what you're looking at here, and I wanted to start with this point because we're seeing a lot of this online, is this relationship between Bitcoin and M2. And there's no doubt that relationship goes in and out in terms of its correlation, its strength over a macro cycle. But what is very interesting is that towards the end of a cycle, when you really start going into speculation, when you're basically going up this wall of worry that people talk about, right, on the risk side of the equation, you can definitely see that there's a very clear delineation between Bitcoin and its validity as a basically precursor to what is going to happen in terms of inflows of liquidity. So what you basically see here is that we don't only look at the correlation, because I think that's a very linear and kind of one-dimensional way of looking at it, but we care about the momentum and the rate of change of that relationship. And what you see at the bottom between basically these green and red areas is when that liquidity rate of change is shifting. Using a lag of 90 days, like everybody is basically saying it's between 87 and 110, we find that 90 days from a inflection point perspective is actually much more indicative. And what you can see here is that this inflection point has actually been very good at giving you an idea of where, in broad stroke perspective, macro perspective, where those inflection points have actually been in this current cycle. So this current cycle meaning ever since basically September of 2023, right? Which has basically been the upwards basically trajectory of Bitcoin as an institutional asset. And this is really important because the liquidity that has been coming in it's been basically absorbed from other asset classes. Okay. And what's very interesting to touch upon Willy's point as well is that we have seen a reduction in that rate of change, so a reduction in the momentum, but we're not in any way close yet to that big basic inflection point that you would expect in a decrease in liquidity. What that basically tells us is that we are definitely getting towards the later innings of this macro cycle. I think we have another couple of months, maybe 2 to 4 months, as Willy mentioned before, of strong tailwind kind of air that pushes up the asset prices. But we are definitely getting towards a point where that inflection point becomes more and more important. What we then can also do is that we take that perspective of M2 and we look at it from a purely Bitcoin agnostic perspective, a Bitcoin specific and non-agnostic perspective. So what we do here basically is that we track from an on-chain perspective when the flows of capital are going towards the asset, which basically means that we get closer to 1 on the y-axis, and when flows go away from the asset. Okay, so basically people selling and taking profit, as Willy mentioned before on the SOPR, that is very clear, and how that money basically goes to the sideline, right? And that's basically what you can, in a more holistic way, define as the stablecoin dominance, right? Which is something that people look at very, very carefully, and that we look at very carefully as well. So we care about that relationship, and you can see that every time that you have a reduction from an on-chain perspective in that relationship, you basically are getting to a point where the system is getting exasperated. Think of it like an elastic band that is just not able to stretch any further and starts snapping back into position. That's exactly what this is measuring. You can see that as well on Ethereum. It's obviously slightly different because Ethereum strength is a lot less persistent. It comes in and out versus Bitcoin because it is a more speculative asset, right? It gets used in a very different way than people use Bitcoin for, right? Bitcoin is more, even though obviously it's always dangerous to look at labels, it's more of a store of value. Ethereum is a store of value, but it's a lesser store of value versus Bitcoin. It's a store of value within the DeFi ecosystem, but it's less a store of value between a macro portfolio, right? That a TradFi or an institutional investor would use to kind of position their portfolio with. And you can see that as well with Solana. The difference with Solana is that it's a lot more sporadic. So this basically pops in and out a lot faster because the amount of profit taking, the risk taking that gets done through Solana is also very different. The mechanisms are fundamentally different. But you see also that Solana and Ethereum, especially over the last 1 to 2 weeks, had a very strong first repositioning, but they haven't been able to be persistent. And for a real alt season to occur, you want persistent flow of capital towards the asset class. And the more stable that flow is, the more likely it is for that money to then start rotating into areas that are further out in the risk curve, right? Because people become confident that the value of Ethereum is maintainable. They perceive it more as a short-term store of value, and then they take risk with the excess capital that they have at their disposal. So what does that actually mean in terms of the general context? What we're looking at here is a proprietary dashboard that we built on the Swissblock side, which we call Hawkeye. And what we basically want to do with Hawkeye is to combine together all the knowledge that we've done, that we've gathered over the last 12 years, being systematic traders, doing research and on-chain, and also understanding Bitcoin as a macro asset in terms of how does Bitcoin fit in a macro portfolio, right? When you have other commodities and equities and fixed income, like how does that actually play a role, and when does it make sense to be overweight and underweight, right? So combining all of those different factors together and creating what we call the Hawkeye framework, which is a layered approach. So combining 4 different key things: on-chain dynamics, micro price structure through our systematic trading algorithms, macro structure through analysis of liquidity, and rotation of capital. So understanding when capital starts rotating out of Bitcoin, and understanding if that capital goes into cash or if it is actually rotating into Ethereum and other more risk-on types of plays. And what we basically do is that we take that concept and we look at it from the different lenses. So to give an example, what we are currently looking at with Willy, and actually this is, by the way, something that we also then have in the vectors, which I will get into in a second, how this relates to the reports and to the signaling system that we've built as well, is that we basically care about the actual rotation of that liquidity. So as you can see here, in the middle part of the visual, you're basically seeing 2 things: a measure of network growth. So think of it like the number of market participants that are in the system, and the blue line is the liquidity. So the liquidity is basically, to keep it very simple, it's the measure of how fast and how frequently those market participants are interacting with each other. And this is important because the more they interact with each other, the more likely it is that that has a positive flywheel effect into price. The less they interact with each other, the more likely it is that that has a negative effect in price. Think of it like velocity of money in the real economy, exactly the same thing. And you can see that we've actually had a reduction of that, as Willy pointed out before, that actually started aligning with the actual top that we saw late May, right? So the top that basically came out of the bottom in early April. And what's actually super interesting is that that has actually seen an inflection point 2 days ago. So we're actually in a very negative trajectory where the number of market participants and the number of interactions between market participants was dropping off significantly, but we're now seeing a cusp. So basically a potential reignition of that liquidity, which is exactly what you would need for another move up in price. How does this basically link again to the liquidity the liquidity measure that we saw before? We think that we're going to get another move up in Bitcoin, a likely rotation now into Ethereum as well, as Ethereum starts gaining relative strength versus Bitcoin. But then we actually think that the final move, right? If you look at the more forward-looking metrics and that are more on-chain based, more liquidity based, we think that final move is likely to come towards September. It could be earlier than that, but the likelihood, just seeing the way that these phases play out, is in September. Now, what's also very interesting is that when you look at this from a profit-taking perspective, so going back to the SOPR analysis that Willy made before, you can see that we're in a very dominantly positive environment still. We had a small little scare that you can see here that got triggered in the sell-off that we saw earlier this week, on the 23rd, roughly. And that indicated that we were getting very close to the system's break-even point. So one of the positive things for those of you that don't know is that on-chain is world-class in understanding social behavior, right? It's giving you an understanding of where people are accumulating, where their max pain point is, because you know exactly what their cost average is. If I know your wallets, I know exactly the level and the price that you bought Bitcoin at, and I know where it's going to start hurting if price falls below a certain point. And this is very important from a mass psychology perspective, because you get an understanding of where price becomes very elastic for people, because they get very scared that they're going to have massive drawdown, so they tend to sell, and that can create a panic effect, right? So you can basically localize the areas where panics are more likely to happen. We've got very close there, in the same way, kind of, if you look over here in that kind of mid January perspective, when basically was the last time that we had a major run up in the system, you saw that got preceded then by a massive profit taking scenario. And that's actually what led to the bear market, or the intermittent bear market, and the collapse of liquidity between February all the way to basically early April. That was basically driven by profit takers. You can see that very clearly here. Same thing that happened mid of last year, same exact pattern. Now, what does that actually tell us when you combine those factors together and actually combine it and look at it from a price structure perspective? What we tend to look at is something called the alt impulse aggregation. So what this basically does is that it aggregates together the top 350 liquid assets in the space. So up to, basically think of it like the top 350 market cap assets. And it looks at the microstructure of each one of those assets. And what it does is that it aggregates those together and flags when those microstructures are becoming exponential, both positive and negative. And what that usually does, and if you look at this more from a historical perspective, so let's say if I move this back to 2023, you can see that these aggregations have lined up with major liquidation events, major sell-off. Think of them like capitulations. And this is actually highlighted with the red curves that you see here. The last one basically being, for those of you that follow us on Twitter, we actually did highlight this earlier this week. We basically said that we were very likely in a actual bottoming phase on the 22nd. I can share the tweet afterwards, because this signal actually triggered. The last time that it triggered in a major bottom was on April 8th, April 7th, 8th, and 9th, which actually confirmed the major cyclical global bottom within the last roughly 8 to 9 months, which was basically then. It also triggered in early March, because that was actually the next major capitulation event, and also triggered basically early February, when we had the massive liquidation event, more on the perp side and the, let's say, the leverage side of the equation, but you also had a major capitulation event there. What it also does, because you're looking at the underlying basically microstructure and exponential nature of that microstructure, it also basically aligns very well with local tops. So whenever this starts triggering, like you can see here as well, you can see back here, and also here, it triggers local tops because it tells you when there's excessive profit taking. And obviously you can always align that again with the risk signal that I mentioned before. So you can see, for instance, the last time that it triggered, you could also see that the last time that it triggered was around here. You saw that basically around 2 or 3 weeks after, you had a massive global top in Bitcoin as well. Okay, so they're always going to lead up in terms of tops, and we're going to be able to give a very good indication of a bottom when those events play out. What we then also look at, which is equally important, is combining all of those factors together and look at how capital rotates within the system, right? So it's not only about Bitcoin strength versus cash or Ethereum, but also how that money actually propagates through the system. And this is important because it's a precursor to risk-taking, right? And a precursor to risk-taking tells you that people are comfortable in the system to be able to use their excess money to start investing in smaller in smaller plays, expecting asymmetric returns, right? And that's basically what we call FOMO and eventually alt season. And what's interesting with that as well is that for the first time in a very long time, and I really mean a basically since the mid part of last year, we've actually seen a prolonged period of time where capital was actually flowing into Ethereum, right? In a consistent basis where there was real relative strength in Ethereum versus Bitcoin. And this is super important because you want to see that. Think of it like building a strong foundation for a house to be able to build the layers on top, right? It's exactly the same thing in the market. You will not have a strong alt season if you go from Bitcoin directly into high risk. Something that, for instance, happened back in November, December. The reason that was not as strong, or it was basically very short-lived, is because a lot of the ability for Ethereum to absorb the capital and become a store of value goes out the window. So basically all becomes very sporadic and very short-term, right? So it basically means you basically run in, make your quick buck, and you run out, right? There's no sustainability to that. And that is an issue because a lot of the projects within the space, they store a lot of their reserves in Ethereum, right? So it stifles their ability to actually reinvest it in the system if it's through liquid tokens or also even investments, right? Which we need to grow the system. Again, talking about network growth, right? Network growth comes from people joining the system, people building the on and off ramps towards the traditional finance system, which then creates a positive flywheel in the adoptability and the use cases for crypto. So we want to see that stay high as long as possible. What else? Yeah, so we have also, I think this is maybe something that Willy could explain further, but we also look at, since as a fund, we're also very macro driven. So we don't only trade crypto, we also trade basic global macro and equities as well. We care a lot about the relative flow, not only within the ecosystem, but also how money flows into the system through ETFs and other proxies into Bitcoin and eventually Ethereum, and also how money flows out of the system. And this is basically what you see here. So what we basically mapped out is basically understanding what basically exogenous effects are actually driving Bitcoin price. If it's through on-chain behavior, which is the y-axis, and external macro behavior, which is on the x-axis. You can basically see that we've now basically done a full circle, a full cycle back to end of May. And end of May was basically the end of the actual first part of this last innings move in Bitcoin, right? Ever since basically, I would argue that in June, it's been a distribution phase and a reaccumulation phase more than anything. I don't know, Willy, if you want to maybe add a couple of points to that as well.
Awesome. No, thanks thanks for that summary, Yann, and thank you again to the 9,000 people watching us currently on X. There is a live chat going on in X. Feel free to comment, drop a question if you're watching us in X, or head over to YouTube. You can also ask a question there as well. And please follow, subscribe. Everyone's info is in, everyone's X is in the YouTube description, along with the Financial Summit as well. Please likes and subscribe to us on both X and YouTube. All right, just had to jump in there for a second. We do have questions, but Willy, why don't you finish up on what Yann was saying, and then we'll ask a few questions, and then we'll see where we go from there.
Yeah, I was just talking about...
please mute, guys, if you're not speaking.
Just talking about that indicator on top right there, which is really measuring the sensitivity of price in Bitcoin. So what really is pushing the price around, and on the vertical axis is the on-chain measurement. So basically, what we're measuring there is the liquidity and the buy demand between real investors who are buying the real coin, not derivatives, and taking it into their wallets. We measure that on chain. And so when they're doing that, is price responding to it? And also measuring its correlation to the macro markets, whether or not the S&P, for example, is going up or down. Sometimes we're just moved by the correlation, even though investors are selling. So we're really looking at those two elements. Is Bitcoin really being driven on its internal engine, or is it being pushed around by global macro markets? And so the top left is where you want to be, where it's solely driven inside Bitcoin as buyers are buying, and it doesn't really care what global macro is. And you can always see that when we have a real bull run. Doesn't matter what stocks are doing. It's only driven by the buying inside its own network. So yeah. So we're kind of slightly neutral, but it's in a positive space where the on-chain is having some amount of impact. So yeah, is there any questions there, Tony, coming from the audience?
Sure. Let me.
Could I just add one thing,
Yeah, go ahead.
Tom, just to kind of make a segue here? So think of it like an airplane that has been going full throttle since basically beginning of April, that is now slowly basically decelerating. It's still basically going up, but it's not going up as fast as it did before, right? So that's basically what we're trying to say. And just to kind of do one segue, what we basically do then, can you still see my screen?
No, I turned off the screen share. Let me know if you want it back.
Yeah, please, if you can just put it back, just to make the segue to the vectors, because I think this is an important point. So what we basically do, based on the explanation that I just gave you before, let me know, Tom, when your screen.
No, you're good. You're good.
Okay.
I'm pretty quick.
So what we basically do is that we take all of the points that I mentioned before with Willy Woo's inputs from the liquidity perspective, our systematic liquidity measurements that we look at basically from all these different markets, also Henrik's perspective on the business cycle, combine all of that together and look at the market through two basic lenses. One that we call the Bitcoin Vector, which is a weekly publication where we basically take all of those different factors and we distill them down to the most important when it comes to the analysis and the understanding of where Bitcoin is, how strong it is, and where it's likely to go. And we break it down into the subcomponents that matter, giving general understanding and explanation of how those components are contributing to the strength or the weakness of the price structure in Bitcoin. And the idea is then to also give you an actual playbook from a structural perspective of where price is likely to evolve based on basically liquidity, based on the liquidation levels, and also based on the basic fundamental underlying strength of the tailwinds that we're seeing or the headwinds. And what we basically also do is that we combine all of that together in a more advanced version, which gives you actual alerts to that system. It's called basically the Bitcoin Vector Advanced, where you basically get an alert every time you have a shift in one of those metrics. It tells you when those shifts are happening. And we also give a daily update versus the report. So since these are weekly publications on a daily basis, we give you a quick update on how that overall structure is shifting based on how the market is changing, liquidity expectations are changing, and the macro landscape is changing. We also do the same thing basically with more advanced, where we also look at altcoins, right? So we have an Altcoin Vector, and then we have the Uncharted, which is the ultimate publication because we add everything together. So think of it like a view of a very deep look at Bitcoin. We do a very deep dive into altcoins and how that relative performance is happening. And then we also combine that together with macro and giving you an actual outlook, combining all of those factors together, expressed into multiple different asset classes. Okay, so for any of you that are interested, we have that as well on our website.
All right, very, very cool. And all right, let's get to a couple of audience questions, and then I'll have a few questions of my own. So, and I'll put them up on the screen for you guys to see as well. I'm starting to learn how to navigate Restream here. So, question is, would that recession be worldwide? The questionnaire says he just spent 18 months in Southeast Asia, and everything seems very optimistic and well there. Europe is, of course, collapsing. That one is obvious. So what is your best guess on what are you expecting from this recession compared to prior ones? Are there any similarities that you've done in your research? I guess that is a question for you, Henrik.
Well, I think we see the same things we saw into the financial crisis. We saw also that everything seemed fine, even into 2008, even though the recession actually began in 2007. So this about that we may feel wherever we go and do our business that things are great. If you look to the consumer, the thing is to understand the consumer. The consumer is everything when it comes to the economy, and the consumer in the US and elsewhere, also in the world, are not feeling good. What it comes down to is really what are they paying in interest payments on their mortgage loans, on their car loans, and so on. And if you take a look at how it looks with the delinquency rates across those, then things are not great. On top of that, you have a housing market that is then also frozen because of that in the US in particular. And then you have the largest bubble we ever seen. So, it seems like we're standing here again, we're standing on a bubble and thinking, okay, what can go wrong this time, even though we see all these the same indicators coming out. I will say that we have there's still time. I also follow some what I call imminent recession indicators, which will give us an idea of when things are starting to unfold. That's not right now, right here, but we are not far off, and I expect to see some weakening in what we all call the coincident indicators there over the next coming months. That means looking at as I said before, the continuing jobless claims, then also spilling into the non-farm payrolls and so on and so forth. These are going to deteriorate as I see it over the next. Let's see again if I'm right. It would be, I don't see any soft landing as people have been talking about, because if you had a soft landing, you would see that the interest payments were to be coming down. You should yields be coming down, and you should also see that that the continuing jobless claims are not start continuing to rise. So I think things are just getting worse and worse slowly. And this is not about, you feel the recession right here and right now. It's something that will creep up on you, and then all of a sudden it'll be there. I mean, you just look back, whoever can remember that, who actually, saw the recession in December 2007 when it actually began. I can tell you Bernanke did not, because he was standing there in February of 2008 and saying, "Oh, guys, if the recession is coming, we'll make sure to get ready for it." That is just not how it works. They are all the time too late. And again, as I say, look to the consumer in the US, and you'll see there are so many weaknesses, completely comparable to what we saw before the great financial crisis. So this is going to be a global one. And the US is actually the strong man, so still the strong economy in the whole group here, the cleanest sheet. And that is, when the economy in the US starts to roll over, the weaknesses that we have seen in Europe, we've seen in Germany, we've seen in China, are going to play out, across the globe as I see it.
All right. Anyone else want to comment on that before we jump to another question?
Yeah, just one thing as well. Short term, there is a uptick in ISM as well, right? So basically the surprise index, which could mean that actually in July we're going to see some positively evolving macro numbers that maybe can catch a lot of people by surprise as well, right? So it's going to be a mixed bag. And I think to Henrik's point, the reason these things are hard to predict is because you don't really know what are going to be the major contributors, but they always end in the same way, right? So the end is always the same. The way that we build up to them, they vary.
All right. Thanks for that, Yann. All right. Next question. And I'm going to add a little bit to the question. So Satwise asks, so what's the bottom line for Bitcoin when the recession hits? I'm guessing we drop with the market and then rise like the Phoenix during the recovery. I'm going to add a little bit to that because there was another question that was DM'd to me. What do you think the four guests think the low price for Bitcoin will be in the next bear market? And these two questions to me are very interesting, right? Because you guys did mention that, yes, the recession has been pretty much written in stone, according to some indicators. But myself included, and everyone on this stream, we are all still bullish. We still think that Bitcoin has more upside before going down. And I find it very, very interesting that more people are asking about how low we're going to go and how the downside is going to be, without first inquiring what kind of upside you guys are looking for. So let's do it as a double question. What kind of upside are you looking for? You don't have to guess exact numbers. I'll throw mine out there. And then what kind of downside, again, best guess. I hate discussing downsides until the top is in. Personally, I like to identify a top before discussing possible downside, because if the top is 250,000, the downside is very different versus a top of 150,000 for Bitcoin. So I personally think that we are going to break 125,000, very likely this year. I think we are. I am 80% confident we're going to break 150,000 on this bull run. Are we going to break 250,000? I'm maybe 50-50 on that. I think it's possible, but I don't think it's, you can't assume that it will happen. And I don't like talking about downside until after I've identified a top. Sometimes I'm lucky and I identify a top in real time. Sometimes I'm very late, like what happened to me in November of 21. But once a top is identified, then we talk bearish targets. So now I just leave it up to the floor. I don't know who wants to go first, maybe Willy, and then we go from there. So what kind of upside do you see time-wise as well, if you dare to take that challenge before the downside?
I mean, I think it starts for me with roughly when, and that's really hard to pick. But I would say September, October. I think it's going to be before most people think. Like, I think a lot of people are planning around December. I think maybe September, early October. Upside, it's really hard for me to guess. I think that we could go 140, 160 conservatively. Absolutely, I think we could go towards, just with knowing how volatile Bitcoin is, we could easily go up to 180. So, you know, in that range, really rough ballpark. Wouldn't really bet on any of that. On the downside, like I did build the CV, what's it called? CVVD model, using destruction, basically the amount of coins that are being that are like so old, people bought from, you know, years and years, and you know the price at which they're selling in gives us a hint of the price discovery today. And so that model was held so far through the COVID crash and also the last bottom. It hit it exactly. And that's sitting at 35,000 right now. So if we're running into, say, October, maybe we get to 37. That model steers around that, you know, let's say 37 and a half. Now, if we're going to go into a complete liquidity collapse whilst we're in a business cycle collapse, we haven't really seen that in Bitcoin since ever. COVID, there wasn't really a complete liquidity collapse. There was a lot of liquidity injected beforehand. So if it breaks this model because of this crazy dynamic, then I think 30K is quite strong. Yeah, so that would be my two numbers, 37 and a half, and if we get a complete destruction, 30K.
Wow, so that's a downside. That's a pretty pessimistic downside projection. By the way, on the screen right now, I'm sharing all prior halving cycles for Bitcoin, including the original one that had a ridiculous percent rise back in 2011. And the bull market tends to top. The longest bull market that we ever had went into October. So if we are in line, we should have a top before October. If we go past October, then we have extended this bull market longer than any other prior bull market. So I just wanted to throw that chart out there for you guys. Okay, and sorry, Willy, while I was looking at the chart, I kind of missed it. So do you have like an upwards target or an upwards price band as your best guess? I mean, how likely do you think we will break 150?
When I said 140 to 180,
Okay, yeah, I missed that part. Sorry
so
about that.
anything in that band.
Okay. Yann, Henrik, you guys want to add to what Willy said?
Yeah, I think Henrik is probably, with his approach, is probably better suited to talk about top targets. But I think with what I can see, I agree with Willy. I think anything between 140 to 165 makes a lot of sense, just in the way that the structure has actually been evolving. It's been very different than other structures, just purely from a liquidity perspective. And kind of going back to the original point that we made at the beginning, since we are a liquidity transfer mechanism, so we're super sensitive to changes in liquidity expectations. If we do get a recession that goes beyond the actual balance sheet recession, so a full-blown contraction in liquidity, you want to be as far away as possible to Bitcoin and other basically assets that are liquidity sensitive. So I think I actually saw in one of the comments is basically the absolute destruction and then the rising phoenix from the ashes. I would expect it to go along those lines. So how low can that go? I mean, if everybody is a net seller, let's assume that a lot of these treasuries that are now accumulating are all net sellers with no buyers. Anything is my guess, right? So it's definitely one of those situations that is going to be super volatile, and I think we're going to see very large highs and very low lows as well. And irrelevant of Bitcoin, just at the point, if that does happen, even 35,000 Bitcoin, you're going to get an absolute wipeout in everything else but Bitcoin, right? So really seeing 99% drawdowns in other altcoins. So I think there's going to be a max reabsorption of capital into Bitcoin.
Well, some good news out of the big bear market that's coming. Henrik, you have anything to add on that before we jump on to another question?
I'll just say very quickly, 148, 164 around that area, because I have some use Fibonacci extensions, and I think that could be area we could see a top in. I very much in line with Willy and Yann. They're saying around about September, October. September is probably my guess here. I actually think that we are setting up for something really bad, because if you look at the companies now that are starting to adopt treasuries, then it seems like people think that that's a good thing. If we're seeing the kind of decline that Willy is talking about, or what I could see, and I'm not sure 30,000 is low enough, in a liquidity shorter situation, you will see balance sheets around and companies starting to blow up, and there will be a lot of selling. You can think about the companies that have been making a business of just piling Bitcoin in. If they have to all of a sudden start to panic sell, that can be a severe situation. So I think this can be, if I'm right on this recession, if I'm right that this is going to be a liquidity drainage into a deflationary part of that, and I can see the Dixie going to 122, I don't think you want to hold Bitcoin at all. And I fear that there will be a panic at the door to get away from this, because it's so liquidity driven as it is. And we don't have to look far away from Bitcoin and say there are so many coins out there, tokens or whatever we call them, that are pure speculation. Bitcoin may have another status as digital gold or whatever it is, but if there starts to be a run on some of these, it will spread to Bitcoin as well. And that's why I'm just cautioning here that people may think that now we have all, the fantastic, the greatest assets ever. I mean, you can go back to the 2000 that we talked about dog pet food or whatever it's called, that we had the fantastic valuations there. Nobody understood that could actually, you don't need to earn money. It was the case, was the talk, right? Then we had 2007. Real estate market will never drop. Why should it? Now we have Bitcoin. Bitcoin is the newest asset. It's the finest thing ever. Why would it drop? And whenever everybody jumps to that boat, I just think, being the little boy in the Emperor's New Clothes, saying, guys, we need to be careful, because it's liquidity driven. That we can see very clearly. And if liquidity becomes a problem, and I think it can become a severe problem, I think you can see an outright crash. And I just want to say, go check what Ray Dalio said at some point on what his downside target on Bitcoin is. And I could see the same. I just want to say that I put it like that.
What number was it? What number was it, Henrik?
Yeah, that was 3,000 to 4,000, and that'll be the case.
Yeah.
I mean, I'm saying we'll have to see. Bitcoin will have to prove its worth. That is the challenge, and everybody will come to a challenge in their life and say, prove your worth. So if Bitcoin can go through that with around 16,000, which I could also see as a target, then I think it has a worth. But if it drops down to those levels, below that, and he gets, his target, I could see that technically unfolding. Then there will be an implosion in a lot of companies around the world, and I think that could be the killer of this at some point. But I'm just saying, I don't want to be the boomer here, because I am probably the oldest guy here. But anyway, it is something we should be careful about if we see that kind of liquidity situation.
Wow, that's a cold plunge coming right here. Okay, so two quick follow up. Obviously, you mentioned it about the companies that are using Bitcoin as the whole point of having the company, just acquiring more Bitcoin. The main one is, of course, MicroStrategy. About 3 more companies like this have spurred up this year. More are coming. I mean, people are messaging me with prospectus on these types of companies. I am a little hesitant to invest in these types of companies. My biggest concern has always been the custody of these coins. My biggest fear is everyone is holding them at Coinbase. To me, that's a huge concern. If the US government was to ever start to collapse, we would get the 1933 FDR Gold Act all over again, where he just confiscates all this Bitcoin from Coinbase, and he just confiscated MicroStrategy's Bitcoin, basically everybody's Bitcoin, right? That's always been my biggest concern. Same thing with the ETFs. But we're not going to dive into this. Obviously, there's really no additional insights we can get from that. By the way, the S&P 500 has just hit a new all-time high as of right now while we're on this stream. And Bitcoin has obviously been very correlated with the stock market since its existence in 2009. The stock market has been on a bull run, and we're at a new all-time high, and Bitcoin is right next to its all-time high of 112. We're only at 107. So, but the real question is, if Bitcoin continues to be correlated with the market, and what is the hedge, right? So how do you, what do you do? If you identify the Bitcoin top and Bitcoin is going to drop, what do you buy? Obviously, you guys aren't going to recommend the S&P 500. I doubt you guys are going to recommend buying gold. It's the whole reason Bitcoin is supposed to be better than gold. Oil is not a good asset because it's too volatile and it's an infinite amount of oil in the ground. It's a matter of just extracting it. I agree that the US dollar is going to skyrocket, but stacking $100 bills in your house is also not a good idea. And some of us on this stream are nomads. We have no house to stash $100 bills in. And what do? Do you get into stables? Do you buy into Tether, which mostly holds US short-term treasuries, which will have their own risks? Do you buy real estate? What do you guys recommend?
The Swiss franc as well. I think that's an interesting one.
That's a good point.
Man, you guys in Europe really don't see the collapse coming, like at all. It's
Yeah, William, maybe you can start out. I think you have a very good view on this one.
Is this mic on? I'll just double check. Hello, can you hear me? Anybody?
Yeah, we can hear you.
Okay, good. Right, good. Couldn't find the mic button on here. Yeah, look, if you want to say hedge, right? Hedges is like an insurance policy. Well, we've got these great Bitcoin treasury companies that are over leveraging and trading MNAVs of 8. So if you want to hedge a small short position, you kind of get with Metaplan 8x on the MNAV, it collapses to 1. 8x leverage on that as it's collapsing. Now, you really want to look into, there's a whole area. I've only just started looking into it with the research, but like, for example, well, actually, we want to look at, will these treasuries liquidate? Will they liquidate? If they liquidate, the MNAVs, might be 1, but actually the Bitcoin's being poured out of it and the prices continue to drop. And a lot of these companies might get liquidated, and just on debt structure, let alone the leadership team saying screw it, we'll sell the Bitcoin because they're scared or they want to buy the bottom. But with Metaplanet, I know a lot of people bullish about it, and they're playing a timing game. They're doing a synthetic ATM where there's another entity, and they're playing kind of a complex spread game, and they're flowing capital into MetaStrategy, and then it pays back the debt, and then they open up a new tranche. The last tranche is well north of $1 billion, I think. And no, sorry, it was $300 million. Now, if they get caught on the wrong side of that trade and the bear market turns, the whole point of their kind of spread game that Evo Fund is doing, that side of the trading doesn't execute, and they can no longer generate cash to pay off the debt, send it back to Metaplanet. And in that case, they've got this big debt. Evo Fund has no sort of long dated maturity. Like MicroStrategy, that's 8 to 12 years. They're good. The 8 to 12 years recovering from any kind of cycle is pretty safe. But for these guys in Evo Fund, they can call back the debt immediately, and then Metaplanet is forced to sell those coins if they get caught off guard. Just recently, they paid off the debt. Let's see if they do another charge. If they get flat-footed, then yeah, that's an example of missing the timing on it. And I'm pretty sure there's other treasury companies out there with weak debt structuring. So here, there's some free 8x leverage and potentially extra juice if they get liquidated on the bear. That's a nice hedge. Being in cash is great. I think Swiss franc is good. I'm personally hedging out to a basket of I'm hedging out to a basket of Swiss francs, euros, and Japanese yen. Typically, they do okay in
Sorry, what was
a
that third one? Sorry, Swiss euros,
yen
and then what's the third one?
and yen. That's a
Yeah.
very longer term sort of thing because US dollars is going to run up. I think the Swiss franc's pretty good. The way I'm hedging it is rather than trade against the US dollar to Swiss franc, for example, I would trade, I would short the Hong Kong dollar to the Swiss franc because it's cheaper funding rate and the Hong Kong dollar is pegged to the US dollar. And if that peg breaks, then you're probably going to catch upside because the Hong Kong dollar will repeg at a cheaper rate against the US. So yeah, I mean and then yeah, just cash. I mean, I, yeah, it's people think I'm a maxi. I am a maxi, but I'm always gonna have a cash bag to weather the volatility, and particularly in a bear market, I tend to de-risk and take a lot off the table, and buy back when the risk is dropped.
All right, so just one quick follow up on this. So I think we're all in agreement that this benefits the US dollar. So the US dollar is going to run up. So if the US dollar is going to run up, why diversify into other fiat currencies instead of holding on to the US dollar? So that's question one. And question two, before I forget, do you see any possibility that Bitcoin would decouple and run up with the dollar? As I know we've been correlated with the stock market, and it's we can all assume that Bitcoin is going to crash when the stock market crashes, and that's my assumption as well. But out of blind hope, is there a possibility that as the stock market crashes, the world would find Bitcoin as the safe haven, so it would finally act as more correlated with the dollar, going up with the US dollar, and negatively correlated to other risk assets like S&P 500?
Uh, Maybe I'll jump in because I remember 2008 very clearly, and for a lot of times, let's say 6,000 years, gold has been the asset and it has been the safe haven. In 2008, gold sold off sharply. So if an asset that's been around for
Agreed.
6,000 years and is considered the safe haven, then it's going to sell off. So we're really left with this is a flight to safety. It's like get out of everything because it's crashing. And therefore, what do you buy? It's going to be US dollars. What's running the US dollars? Swiss francs. That's the safe haven, actually, a short-term safe haven, right? It's only through these shock events. Yann, Henrik, anything to
Yeah,
add?
I agreed. I'll comment. I'll add to that gold comment, and I said this back then as well, and not in real time, but obviously after we saw what happened. And my view was, look, when stock market, and I was at Bear Stearns, so I experienced the 2008 financial crisis firsthand, when so many people lost their jobs and potentially their house. No one was buying gold. If you had any gold, even in your teeth, it was something to sell to put food on the table. It was happening all over the world. People were selling their jewelry. They were selling any gold they had in order to feed their family or to pay, one more month of rent to have a shelter. So gold was terrible. Now, once it all ended, gold was the first asset to recover because everyone was still scared of the bank and stuff like that. But as a counter argument to myself and you, Willy, in 2008, there was a lot more confidence of the globe in the United States. That is not the same anymore, right?
Mhm.
I'd say in about 2 to 3 years, China and Russia will have more confidence than the United States, because I think the United States is putting itself in a very, very bad position globally and economically and politically, where I don't think the world sees the U.S. as a safe haven like it did 15 years ago or close to 20 now.
I think that is true, Tone, but I think there's another point, right? So if you look at the amount of world trade that gets done in yen, it's insignificant compared to the dollar, still to this day, even though it has been decreasing over the years in a very dominant way. It's in the shock events that you start realizing what is actually worth something, right? And I think that's going back to the point that Willy made.
Right.
That
But yen is a rough comparison, right? We should be
yeah.
looking at the increase of international trade in yuan, rubles, and
Yen, that's what I meant.
Indian.
I didn't mean yen. I meant yuan.
Okay.
I mixed up the two. Yuan. Yen is different story. The yuan, but it's kind of because again, it's not seen as a store yet, right? Like even bilaterally, right? Even there's actually bilateral agreements between Russia and China that are settled in euros, right? So there's like a lot of things to unpack there and kind of peel back the onion layers. But I think what's also interesting to your point, it's not only about the crash, but how we expect these things to recover. And I do see Bitcoin recovering significantly. And there is that one interesting case where, to your point, Tone, if people lose faith in the dollar, coupled with a lack of dollar liquidity, so think of it like Argentina needing to raise dollars to be able to backstop their own liquidity crunch, right? To be able to kind of protect their current account surplus or whatever. At that point, maybe the dollars aren't available because at 122, 130, the dollar wrecking ball is just going to wreak havoc in every possible microcosm of the world economy, where an alternative becomes interesting because the opportunity cost at that point of saying, we don't have any other choice, might as well just buy Bitcoin, could actually be a kind of a ditch of last reserve, if you can call it that. So I could see that scenario, but I think the more likely one is collapse as liquidity dries up, and then a fast recovery like gold did back then, as people they're basically not really trusting the system, maybe putting money into the bank, these types of things. I see that as well.
Gotcha. All right. Any final comments on this? I got 2 more questions. All right. We'll move on. I'll post a question, and then I'm actually going to do a little bit of screen share. Question Tone. So in the final hurrah this cycle, can we expect a total collapse of shitcoins as all the capital panics into Bitcoin? I will slightly elaborate on this question because I want to pull up the chart of Bitcoin dominance. And I actually found surprising when I was watching your streams, guys, that you did over the prior 2 weeks that you posted to your YouTube channel. And all I see is Bitcoin dominance rising. Now, this is a custom Bitcoin dominance. Now, this is a Bitcoin dominance that excludes stable coins. So this is pure Bitcoin versus all other altcoins. I call them shitcoins. Ethereum is on my shitcoin list. As you guys know, I am a maxi. And I just don't see, I can see Ethereum being the store of value in the shitcoin bucket, but I just don't see Bitcoin losing any market share to Ethereum. And if we actually pull up the more recent charts of other alts, and Solana has been the best performer over the last 2 years. And if you even look at Solana over the last year and a half, even it is dropping significantly where I think it's topped. I mean, there might be something else that's outside of the top 10 on the shitcoin list, and BNB is also going down as well. And to me, Ethereum is in a very, very bearish posture. I mean, maybe there is something on the horizon that will be rising for the next 2 years and maybe make it into the top 10, maybe into the top 5. But out of the current top 10, including Solana and BNB and Ethereum, and Litecoin is not even there anymore, let's exclude the stable coins, I just don't see an altcoin rise versus Bitcoin. I can see Ethereum going back up because it is more stable in the shitcoin space. So can we just talk a little bit more about why you guys think that Ethereum may go up against Bitcoin, not against other altcoins? I think that's totally possible, but against Bitcoin specifically, because I just don't see it, because I don't see how it is needed at all for anything. I mean, I'm dying to see Tether being traded on the liquid side chain, which it never really picked up. But other than Tether use case, and that's moving over to Tron more so than Ethereum these days, uh, what can possibly cause Ethereum to rise against Bitcoin?
I think there's a narrative game, right? So we have to subdivide long-term and short-term time horizons. So I think short-term, really looking at now until September, to kind of look at it as a kind of a cliff event, right? To whatever happens after. We have a narrative that we have not had, I think, in the last 2 to 4 years, which is basically a potential ETF now with 90% chance that allows for a yield, right? So basically yield-bearing ETF. You basically have the SEC coming out and basically pretty much giving a roadmap to actual DeFi innovation and allowing banks to actually build, kind of contracts and stuff on top of DeFi, kind of green lighting DeFi to some extent. So you have a reason to start looking at it again, right? So there's like different elements within the narrative, and I'm talking purely the news narrative, right, of what it can become, where people can start using that and saying, okay, this maybe has some asymmetric potential. Now, in terms of trading against Bitcoin, I'm fully with you, Tom. I think it's been, if this cycle is not proven to you that Bitcoin is the king and the game in town, then I don't know what other proof you need, right? It's clear that everything is lost versus Bitcoin. There's maybe 1 or 2 scenarios that you can argue that have liquidity, let's say a SUI or something along those lines, that is big enough for you to trade volume, that has outperformed to some extent. But leveraging Bitcoin would have been a much better play since late 22 than pretty much anything else, right, at scale. So absolutely, and I think that's going to keep happening. I think this quest for the killer feature has already been there for years, right? Bitcoin is the killer feature, and stablecoins are going to be the flywheel that make that even more the case. Bitcoin is the winner. Now, the key question out of that becomes, what does utility look like as we move out of the speculation cycle? And I think there's indications on chain that we really are starting to see the first innings of utility as stablecoins become more proliferated, I think, to the financial ecosystem. There maybe are things that rise out of that, right? I'm talking specifically RWAs, these types of things. But there's really no proof right now that is the case. I don't know, Willy, what do you think?
Yeah, I want to zoom out a bit because we were talking about dominance, and there seems to be a misunderstanding throughout the whole industry what altcoins are, because they're not Bitcoin. Bitcoin is a store of value. For the most part, generalizing here, is that the altcoins are actually technology. You're buying technology. You can liken that to Silicon Valley startups. It's not all the money in the world, right? It's only a small part of all the money in the world. And if you look at Bitcoin at $2 trillion today and going to 100 trillion in today's value, that's a 50x growth ahead of it. Now, if you work out what altcoins are, 1.5 trillion, for the most part, excluding all the meme coin garbage, that's casino. You could call that's entertainment, but there's GameFi, there's DeFi. Financial services is 5% of the world economy, roughly 5% of the market cap of public equity. So that's $5 trillion. Then you layer on GameFi and other uses, you get to this figure at full saturation of $15 trillion. So you run that ratio of 15 trillion versus 100 trillion, and you will get somewhere around 85% like dominance of Bitcoin, because one basket is a whole bunch of technologies. And this is why you see the majority of altcoins die, because they're failed technology startups. 98% of startups fail, yet it's like 10 times worse, 100 times worse in altcoins, because the incentives aren't aligned. You can sort of exit scam. And so that's where we're heading to, but doesn't mean they're terrible investments if you pick the 1 in 1,000 coins that are gonna win. Ethereum's 8,000x above its ICO. So that was one of the few winners out of all of it. And so, but I would leave that to the specialist guys that are inside doing that kind of pick. Generally, the insiders, which really you know, the maxis will say, such as myself, is that's stacked against retail. If I'm an inside round and buying, you know, Solana at whatever it was, 50 cents, and then it runs up to $200, that's the unfair advantage. But that is the venture capital game, and that is technology. So that's the game in town. Like, you know, when we talk about altcoins in the short term, they are just, you know, sloshes of capital moving in and out of Bitcoin. It used to be altcoins were great. When Bitcoin was going sideways, you can get more gains by rotating into the smaller bucket size, so the price would run up more. That kind of has fizzed in the cycle because, well, we've got treasury companies now growing the MNAVs, and those are the things that are running up. So they're getting competition on that front. But at the end of the day, it is technology, and there is utility, not just stable coins, but Vays got $24 billion of value locked in lending. People are buying houses with it by fronting their collateral and pulling out stables and converting that into real dollars in a bank, to where the bank might have refused their mortgage because they didn't recognize Bitcoin as collateral. So there's value there. You know, it's overinflated. You know, we thought this was the new competitors to Bitcoin. Back when we were naive as an industry, 2017, there was the big altcoin bubble. You'll notice every single cycle is dedicated and never reached the same highs against Bitcoin. So I think it'll just continue to fizzle, right? It'll go up with the bull market and it'll fizzle. This one was a real fizzle because it's the third bubble, and people usually learn by the third time. So yeah, ultimately, I think we're going to revert down to that ratio of like 85%, maybe higher, right? The 15 trillion of captured market, total addressable market, is on optimistic side. That's if they get a big, decent chunk of trade pie. If they don't, then dominance goes even higher. Long term, it'll take 10 years, 20 years to do this.
All right, we're going to be wrapping up the show. We got a few more questions. Hopefully this would go quick. Irish Times published today how Stripe is lobbying the Central Bank of Ireland on crypto stablecoins. Are we at the start of a boom for stablecoins, and what impact will this have on Bitcoin? So this should be a quick answer from the panel, I think.
We can go on this. Yann, you want to talk about it? Or?
No, go ahead. I'll follow up with you.
Okay. Stablecoins are huge, right? They're effectively dollars. It's fiat running on blockchain rails, so it's 24/7. It's fast, and it really, really came into its own when, well, it was they invented because the whole industry was unbanked, debanked, and unbanked. So when you can't get a bank account, what do? You use proxy banking called a stablecoin. Originally, that was Tether. Tether solved the banking issue. Therefore, all the early exchanges, Binance, OKX, now Bybit, these really large exchanges, they're trading billions per day. But most of the liquidity and volume is all trading against Tether because that's the other side of the book. If you're going to trade Bitcoin, crypto, anything, you need Tether on the other side of the book. It's not US dollars, right? So as Bitcoin grows another 10x from 100,000 to a million, then AUM inside these stablecoins is going to go another 10x. So like you can see that has consequences. That means Tether growing 10x will be more profitable than the top 5 banks put together. Bigger than the top 5 banks put together. So they will own banking. The other thing is that they will displace US treasuries, all of China, all of Japan, who are not buying it anymore and selling. And so suddenly you're in a situation where the US dollar is effectively propped up by the debt owned by the stable coins within Bitcoin, because it's all driven by Bitcoin. So it's interesting where Bitcoin, if you pan this out, Bitcoin $1 million, Bitcoin starts to control, the dollar in terms of the debt. Who's buying those US treasuries? So that's all I've got to say with that. Yeah.
No, I think you're right. I think the direction is exactly that. It's the question becoming who's the marginal buyer of US debt, right? And I think stablecoins, as they currently exist today, are an absolute candidate to kind of continue the trajectory of basically, you know, monetizing debt that the US is on. And I think until there's basically no more buyer of last resort, that's when the situation that Tone mentioned before becomes a real issue, right? Think of it like a Bretton Woods 2.0, where you have to basically go back to the drawing board and kind of redefine, gerrymander around positions to redefine a basket of currencies that underline a kind of a world-denominated FDR or whatever it ends up being. So yes, stablecoins, I think, are massively important for the US to continue its current trajectory. And I think the banking system is going to be, you know, enabling that in a big way.
If anyone is wondering how much U.S. debt Tether holds, I just posted the link to my Google spreadsheet in the YouTube live chat, and here I just added Tether recently. Don't ignore the numbers from the past. I just wanted some kind of a line. This current number of 100 billion is accurate. You can get it from this link right here. You may have to do a little bit of math, but all the information is right there on Tether's website, how much US debt they have. Just keep in mind, Tether holds T-bills, which is short-term US treasuries. Well, not technically treasuries, but it's short-term US debt, less than 1 year to maturity. And you can compare this to how much other countries hold. I have this spreadsheet that I've been maintaining for people to see. It's free. And you can see how Europe has significantly increased their holdings of US debt. That's Europe collectively. I have it broken down by each country in Europe as well. Luxembourg has been on a complete tear, buying up all kinds of US debt, Luxembourg and Belgium. And you can see Tether holding $100 billion of US debt is more than countries like the Netherlands, Spain, Sweden. So it is very, very significant. So if anyone is curious what the trends are, and the reason why I started looking at this data is because this is absolutely incredible. Russia diversified itself from all American debt. I have Russia in here somewhere, probably under BRICS. Uh, Russia diversified everything to zero in 2019. So they knew what was going to happen. And you're seeing it with China now. You can see the quick drop. In fact, for the first time ever, the UK now holds more debt, US debt, than China. That's as of this year. The UK now holds more US debt than China. So you can actually see potential in escalation between countries based on how they are, or friendliness of countries based on how quickly they are picking up US debt versus how quickly they are getting rid of US debt. And China is dumping US debt very, very quickly, and India is not increasing its US debt. And the moment India starts heavily dumping US debt, you know a conflict's coming between US and India. I find this data to be absolutely awesome ever since I started tracking it. So anyone's welcome to have access to the spreadsheet. I threw the link in the video description. And like I said, I just added Tether. All you got to do is click on the link for Tether. And then here under transparency, it is their own transparency. They tell you how much reserves they have. You take 81.5% of that. That's the debt that they hold. And then you take 80% of that, and that's US Treasury bills. So it's very, very simple math that anybody can do, and you get approximately $100 billion. And you can kind of keep an eye on how Tether is doing. You guys have comments on what I just said, guys? Or we have one?
There's somebody, Tone, that asked where the money went. So the money got diversified into roughly gold, yuan offshore deposits as well, because the increase in trade, and especially energy trade between Russia and China, and also the national sovereign wealth fund that Russia has. So those are the three main areas that the diversification went into. Could be others as well.
All right. Yeah, cool. Thanks for the additional info. All right, let me jump back off of screen share. Oh, I see Henrik wants to jump back in. I'll put him in a second. And our last question, which again, I kind of almost have to ask, even though it's a bit of a trick question. Tone, what do you and the panel think of the paper Bitcoin in circulation and its ability to manipulate the price action? So anytime the word manipulation comes up in a financial discussion, I always have to do a disclaimer. And here's that disclaimer. There are two types of manipulation. There is malicious manipulation with acting on information. And then there is, natural manipulation because you have more money than the guy next to you, right? So we have to be very specific when we talk about manipulation. So, and no one ever distinguishes between the two. So let's briefly mention malicious manipulation. If you are an owner of an exchange, let's say a Bitcoin exchange, and you have a lot of inside info on, where the stop losses are, certain people, where their liquidation points are. If you provide that information to some hedge fund that is able to take advantage of that information and liquidate people for profit, that is malicious manipulation. Then you have a situation where you have a lot of money, like you're a guy at the poker table with a big stack, and you can push the table around because you just have more money, but you are playing within the rules like everybody else. Okay, that is the kind of manipulation that is not malicious. And my answer to, if anyone is complaining about that kind of manipulation, go drive an Uber and stay out of the equity and stay out of the markets, right? Like it's not for you, right? If you are scared of guys with more money than you, then this is not a career for you. This is not a profession for you. So now that I've explained the difference between manipulation, I would love to get your thoughts, guys, what you have to say. In my view is these derivatives like options and futures, as long as it's not malicious manipulation, I think it's good. I think it creates a little more good than bad, but that doesn't mean that certain entities can't get over leveraged and then blow up the whole market. But that's part of the financial markets in order to give other people a chance to use these same tools as hedges. Because yes, there could be another long-term capital management. Some hedge fund trading options on Bitcoin blows up the whole financial system. But it allows me to buy some put options and protect against that happening if I want to, right? But again, now we're in the realm of manipulation by the rules versus manipulation with, malicious intent on certain information. I don't want to say insider information because that has a very specific legal connotation to it. All right. I'm done yapping. Go ahead, guys, and I'll bring Henrik in here in case he wants to comment as well.
It probably makes it more bounded, right? Which is something that I think, need. It brings, if you look at the current cycle, it's been a lot less volatile to the downside than previous cycles, because I think it brings in a lot more structure to the process, and it attracts financial players who want to come in, because to your point, Tone, you can actually start hedging. You can start using more sophisticated, let's say, not just D1 type of instruments, but more advanced instruments to be able to actually hedge larger exposures in a correct way. And I think you made a very good distinction before that kind of leads me to the point as well that we need transparency. So I think paper money in general, I think, is a good thing as long as these things are also transparent, because the thing that blew up the system in 22 was also the lack of understanding where the actual risk in the system was, right? So you had all of these different structured products and, let's say, the options and derivatives, but you also had the thing that you call rehypothecation. You have basically one guy borrowing over here and sending it to somebody else, to the point when the cascade started to happen with the unwinding. There's basically not just one party that got destroyed, but basically it created massive collateral damage around everybody else, because nobody really knew who was holding the actual risk on their balance sheet, right? And I think if you want a long-term sustainable system, we need to make sure that we lobby for transparency, right? So we have all the tools to Tone's point. You're at the poker table, you know exactly what the rules are. You can see what the other guy is doing, right? Maybe you don't see his cards, but you can see how he moves, and they're all within the preconceived rules, right? Obviously, avoiding fraud, right? So fraud is always a separate point to what Tone said as well. But I think as long as that's the case, we want that to be the case, right? Because we want large institutions to come in, provide liquidity. We want services to be built up in the system. And for that to happen, you need advanced. You can't just use plain vanilla instruments. Maybe Willy?
Yeah, to the point that transparency absolutely key, but to Tone's point of selling the information at the exchange to a hedge fund, I would say most of the offshore funds that are less regulated have their internal trading team. And so I think that creates a incentive where if they can trade, they can certainly trade against the global client base. And that's why we see the liquidation heat maps work really well, because they're systematically liquidating people for billions of position sales at each flush. So, I mean, that needs to be cleaned up. I do believe that eventually this will be regulated to a point where we get proper practices. And in terms of paper in the system, fundamentally, there's a number of useful stuff with it. You can hedge. It provides extra liquidity. There is one case where it makes Bitcoin heavy, right? And that is that 2017 and prior, if you wanted to sell Bitcoin, you could only a very rare individual called a Bitcoin who bought earlier than you could sell that Bitcoin to you. And so with paper markets after the CME launched and all the perp swaps, all the derivative markets coming, anyone with big bags of dirty fiat could sell you that Bitcoin at high leverage. And so I could park, right now $100,000 and lever it up and sell you $1 million of Bitcoin in paper. If someone wanted to buy $1 million of Bitcoin, I could short that, take a short position, and I could never have done that without paper instruments. So when BitMEX created the first perpetual swap contract for our industry, they were pretty smart in saying you have to collateralize your short position or long position with Bitcoin. So you couldn't just dump near infinite amounts of fiat. Global macro firms have size-wise a ridiculous amount of fiat, and so their shorting power is huge, and they could never have shorted Bitcoin before the derivative market. So that's the only thing that is kind of, I think, dangerous for Bitcoin. That when you look at all of this put together, we're currently at 600,000 Bitcoins in paper contracts that are live. There's a long leg, there's a long bet and a short bet. That's 600,000 Bitcoins of position sizing that's extended beyond Bitcoin itself. So we've got, if it was 21 million Bitcoins, I know it's 19.8 or something, but let's call it 21 million. That means that now the new supply is 21.6 million, because there's 21.6 million Bitcoin exposure in total exposure. And so that constitutes a debasement, and that's creeping up every year on a very steady growth trajectory.
Can I actually ask a question to you, Tom? It's actually,
Sure.
since it's obviously you're from this, you cut from the cloth of having worked in the financial industry before as well. How do you see the net short position on the CME regarding Ethereum? Like, where does that actually come from?
What do you mean? The short position?
Yeah, so like in futures, basically on the CME, basically the paper.
They're all cash settled, right? So
Yeah.
it doesn't matter. No one actually. There is no direct backing. The CME futures are completely cash settled. They're not physically settled. So that's why it doesn't matter, and that's why when the CMEs launched, I always found the CME to be kind of irrelevant. Almost like I find S&P futures to be generally irrelevant. S&P futures do not. That's not price discovery for the S&P. The 500 stocks are price discovery for the S&P, and the S&P future is just betting on the side. Same thing with Bitcoin CME futures. They're not, because they're cash settled. Just like Ethereum futures, they're not price discovery. This is very different than gold or oil futures, where the futures itself is physical delivery. So the futures of gold and the futures of oil are the main price discovery driver of the asset. But in Bitcoin, that's not true. Now, if CME ever goes to physical delivery and it starts picking up significant volume, then the CME suddenly becomes price discovery, which would be very weird because it takes the weekends off. But that's why I never found the CME to be relevant at all for anything, because it has nothing to do with price discovery.
That's an interesting point, actually. Yeah, very good point.
Right. It's kind of like again, it's kind of like you betting on a boxing fight or you betting on a sports match, and you have no control of the outcome, right? You're just watching it as it happens. Versus the two teams that are on the floor that actually have a say in the outcome. And that's the difference between a future that is driving price discovery and a future where people are just betting on the side versus price discovery. Now, if a big entity places a big bet in the futures market, they can then try to go into the price discovery market and try to move the price into there. But that's a very, very different thing than using the derivative itself as price discovery.
I think you should actually do a tweet about this, because I think there's a massive lack of education around these exact, I think, major plumbing and dynamic effects, right, of these different instruments at the end of the day, right? Because I think there's a lot of misinformation that is circulating around the CME on Twitter. At least I've seen it pick up over the last couple of months.
Yeah, no, thanks for the heads up. All right, guys, we're gonna wind this down. I'm gonna go back to screen share real quick just to pull up your Twitter and stuff once again. And most of our viewership was live on X. You can see we are 13,000 views on X. There's a live chat on X as well. A lot of people were not very active in the chat, but thank you all 13,000 of you that are watching us on X. Please like, share, and subscribe to the Financial Summit X account, and check us out on other future streams. Matt and I do a show every morning covering the price of Bitcoin. We have other people streaming about the price of Bitcoin and other crypto assets as well. And thank you so much to our guests. Willy, go ahead and say your goodbyes. And once again, remind people where they can find you and your latest venture, and where they can get more information on your views on the market.
So I'm on Woonomic, and on my profile, there's a link to the Bitcoin Vector if you're interested in that publication. My day job is actually running a fund of funds, institutional grade, and that's Crest Fund. We don't really talk much there. And yeah, that's it. Over to you, Yann.
Yeah, thanks a lot for having us, Tone. We're basically, so personal is Negentropic, but it's really through the Swissblock Twitter, and also Bitcoin Vector and the Altcoin Vector, the major sources of information. For those of you that want to deep dive deeper into on-chain, I think Glassnode is always an amazing tool to be able to really understand the inner workings of how things are developing, especially if you care about liquidity.
All right, and we have all these links in the YouTube description. Henrik was also on with us. Usually he is in his office as well, sharing charts on economics, and he had to jump off. So his info is in the YouTube description as well. He's the head of macro at Swissblock, and yeah, you guys post these analysis to your YouTube channel as well, and hopefully we'll have you back up again. Maybe we can do this once a month, once every couple of weeks, and get your take on the market. Yeah, I'm really looking forward to the start of the fall to see if we will be topping around that area. All right, so unless there's any other final quick thoughts, we're gonna go ahead and get going. Just to sneak a peek at the price of Bitcoin, we are rallying, we are pumping a little bit. Here's the 4-hour chart. Here's the 1-hour chart. Not surprising with the stock market rallying like crazy. I can only assume there is some more peace talk between Iran and Israel, and I think that has been the biggest driver of the markets over the last, this whole entire week, basically, with some stability in that military conflict has been driving the markets very, very nicely. S&P is at a new all-time high, so hopefully Bitcoin will follow soon. All right, guys. Other than that, I'm going to cut off screen share. Thank you for watching. See you all probably Monday morning with Matt McGregor. All right. Bye, guys.
Bye, guys.
See ya.